Are you aware that your spending tends to increase when you're financially strapped compared to when you have an abundance of funds? It might seem contradictory, but this paradox is a prevalent aspect of the contemporary world. What's even more astonishing, a majority of individuals are oblivious to this fact. In the forthcoming video, we aim to unravel the puzzle surrounding the phenomenon of this behavior, and we won't solely discuss theoretical concepts. We'll delve into practical instances illustrating the challenging struggle experienced by those who rely on each paycheck to make ends meet. Have you encountered the boots theory? It revolves around the concept that affluent individuals maintain their wealth by affording high-quality, durable boots, a prudent financial choice in the long term. Skeptical? Picture two pairs of shoes in your mind, one priced at $50, the other at $10. Opting for the cheaper one might initially seem like a bargain, saving you $40, but it could lead to a significant error. The more expensive pair is constructed to endure through any weather or activity, ensuring longevity. Conversely, the less expensive option might deteriorate after just a couple of uses, prompting you to purchase a new pair. Similar to the boots theory, the cost of items does not always correlate directly with their quality. Interested in the spending habits of those with lower incomes? Consider a study on household expenditures. For individuals with limited means, over 80% of their income is allocated to basic necessities, leaving little room for unforeseen expenses. Regrettably, housing alone consumes more than 40% of the average budget for low-income earners. Wondering how they manage such expenses? Reflect on Buffett's advice. The affluent invest in time, while the financially constrained invest in money. It all commences with the seemingly obvious choice of cheaper, inferior goods. Remember the age-old adage, "You get what you pay for?" This principle applies across various aspects of life, encompassing clothing, vehicles, technology, furnishings, and beyond. As previously mentioned, attempting to economize initially might result in significant savings, but it could lead to regrettable replacements or repairs sooner than anticipated. Let's consider a more relatable scenario. Imagine buying a low-cost, generic washing machine purely to adhere to your budget. However, when it malfunctions within a few months, you're left with a laundry crisis and unexpected repair expenses. Alternatively, investing slightly more in a reliable washer could have spared you from additional financial burdens. When discussing challenges, healthcare emerges as a substantial financial burden for those with limited income, largely due to factors such as insurance expenses, medical bills, and the accessibility of high-quality medical services. Reflecting on the age-old adage, health is wealth, this sentiment cannot be emphasized enough. Individuals with lower earnings often reside in polluted, less desirable neighborhoods due to their affordability. Unfortunately, this environment significantly impacts their health. Typically, residing in such areas results in limited access to nutritious food, working in stressful and risky occupations, and an increased likelihood of exposure to workplace hazards. Did you know that individuals with lower incomes have higher rates of heart disease and diabetes compared to their wealthier counterparts? Moreover, their children are more susceptible to asthma. Implementing something as straightforward as a balanced diet could provide the essential nutrients necessary to combat numerous health risks. Yet, sadly, affordability becomes a hindrance, leading to exacerbated health challenges and long-term expenses. Want to understand an even graver aspect? In the United States, health insurance is intricately tied to employment, resulting in an insurance dilemma for many low-income individuals. Even when they have insurance, it often entails lower quality coverage coupled with high deductibles, co-pays, and out-of-pocket expenses. The matter of housing consistently remains a crucial concern. Do you concur that owning a house offers a considerable advantage over renting? With each mortgage payment, one contributes to building equity and wealth instead of merely contributing to a landlord's income. Yet, for individuals with lower incomes, homeownership presents challenges due to its substantial costs for two primary reasons. Firstly, lower credit scores among this demographic often lead to higher interest rates on mortgages, elevating overall expenses. Secondly, constrained budgets force individuals to acquire older homes in poorer conditions, subsequently raising maintenance expenses. This highlights how homeownership becomes more burdensome for those with lower earnings. Consider Ellie, a high-income earner who invests in a relatively new home, reducing her maintenance costs significantly. Compare this to Nathan, earning less, who settles for a cheaper, older house. What unfolds next? While Ellie faces minimal maintenance expenses, Nathan encounters multiple costly repairs, such as a leaky roof, faulty faucets, electrical issues, and more. The outcome? Ellie's housing costs remain stable, while Nathan accumulates a constant stream of expenses. Additionally, let's address the impact of low credit scores. Although not a universal rule, Individuals who are either financially constrained or on the brink of it often possess lower credit scores, leading to increased costs. A low credit score, usually resulting from occasional late payments, typically results in higher interest rates on loans, credit cards, and mortgages. Worse still, this has ripple effects, causing elevated borrowing costs and potential challenges in obtaining employment or housing. The stark impact of poverty is evident in yet another aspect: food accessibility. Low-income households not only allocate a larger portion of their income to food and essential household items, but they also often face inflated prices for various reasons. Firstly, many reside in what we term as food deserts, regions with limited or no access to stores selling essential food items. To address this, individuals with lower incomes are compelled to frequent convenience stores or fast food outlets, where prices tend to be higher. But let's examine the evidence. While the data might be slightly outdated from 2014, it demonstrates the disparity in prices for common products. In neighborhood stores, bananas were priced around $1.18 per pound, significantly higher than the approximately 77 cents at larger stores, reflecting a staggering 53% difference. Similarly, skim milk exhibited a 14% price difference between smaller and larger stores at $4.05 versus $3.54 per gallon. Consider rice, showing a 50% variance. These figures, though difficult to accept, illustrate how families with access to more extensive stores not only benefit from a wider variety of products, but also enjoy notably lower prices on everyday essentials. You're likely pondering why individuals with limited funds don't opt for bulk purchases, aren't you? Well, the crux of the matter lies in the fundamental reality that those with low incomes lack the financial means to make substantial upfront payments. Consider this scenario. Envision a trip to a store like Costco, intending to buy goods in bulk for several months. You decide to purchase items in larger quantities, requiring a significant sum upfront. While the initial expense may seem high, have you ever paused to calculate how much you might save per unit in the long run? The potential savings could be surprising. However, this scenario only applies if you have the means to afford bulk purchases. If not, you'd end up buying groceries more frequently. In essence, financial constraints limit the ability to make prudent financial decisions. It's a proven money-saving tactic that, unfortunately, is unattainable for low-income earners. Renowned investor Warren Buffett once remarked, "If you don't find a way to make money while you sleep, you will work until you die." Even individuals with higher incomes fret over economic conditions and the escalating cost of living. One can only imagine the struggle faced by those with fewer financial resources. Let's move on to discussing how the banking industry creates challenges for individuals with lower incomes. Many are aware that in 2019, banks in the United States collected an astonishing $15 billion solely from overdraft fees. Progressing to 2021 and 2022, this trend continues, with banks still amassing around $10 billion annually from these fees. It might sound peculiar, but whenever your bank account dips below zero and you use your debit card for purchases like fuel or groceries, get ready for that overdraft fee charge. Generally hovering around 35, these charges merely scratch the surface of the banking issues. The brunt of this impact falls heavily on those living paycheck to paycheck who end up shouldering these substantial overdraft fees, which, let's face it, can become exceedingly expensive. You might wonder how an account could slip below zero, but the circumstances of financially challenged individuals might surprise you. It's a delicate balancing act between meeting basic needs and evading financial pitfalls, and unfortunately, this tightrope often leaves individuals with lower incomes vulnerable to costly charges. Let's shed light on another grim reality for individuals with limited resources: payday loans. These loans, often lurking in the background, target those in lower income brackets. They may present themselves as a solution, offering early access to some cash when you're struggling to cover expenses. However, here's the catch. This apparently helpful offer leads to a perilous cycle. The payday loan system frequently ensnares low-income individuals in a dangerous spiral that swiftly plunges them into financial turmoil. Often, those resorting to payday loans are unable to obtain a credit card. It's almost a final effort to obtain swift cash, but here's the frustrating aspect. The annual percentage rates on these payday loans often skyrocket to astronomical levels, sometimes reaching 3, 4, or even 500%. We've yet to touch on fines. Whether they're parking violations, feeding tickets, or others, they might appear simple to settle. However, when viewed as a fraction of someone's income, it becomes alarming. Let's consider a practical example once more. Picture this. You mistakenly park in the wrong area, resulting in a $100 parking ticket. Now here's the twist. If you earn $400 per week, that's a significant 25% of your weekly income gone. But if you make $4,000 per week, that amounts to just 2.5% of your income. In this case, you might not even flinch at the parking ticket and pay it without much concern. Yet, in the first scenario, it hits hard. Same fine, different incomes, different impacts. Can you see why it's challenging for those with limited earnings or living paycheck to settle their fees? This brings us to a crucial point we need to address: the concept of regressive taxes. For those unfamiliar, this refers to a taxation system where the tax rate decreases as the taxable amount increases. Surprisingly, once again, regressive taxes disproportionately impact individuals with lower earnings by consuming a larger portion of their income. It's not solely regressive taxes that demonstrate this trend. Sales tax and certain flat-rate taxes also follow a similar pattern. Consider a 10% sales tax. If an individual with a modest income spends $100, they pay 10 cents in taxes, which amounts to 10% of their spending. However, if someone with a higher income spends $1,000, they also pay $100 in taxes. Although both paid the same percentage, the person with the lower income ends up forfeiting a larger proportion of their earnings. Let's proceed to our final point. Did you realize that in economically challenged neighborhoods where more than 50% of households rent, a substantial number of residents heavily depend on public transportation? Moreover, many individuals who do own a car often opt for vehicles that are a decade old. While this isn't necessarily negative, relying excessively on public transit or older vehicles can pose more financial challenges than benefits. Recall our previous example of Nathan, the low-income earner. Unable to afford a car, he heavily relies on public transportation to commute to work, spending a significant amount on bus fares and occasional taxi rides. The bus routes often extend his commute, leaving him fatigued before the workday even begins. This stands in stark contrast to Ellie, who effortlessly navigates in her car, enjoying a swifter and more convenient journey. Unfortunately, Nathan's challenges don't stop at transportation and time expenses. The absence of a personal vehicle restricts his job prospects, as some desirable positions mandate reliable transportation. Additionally, he faces various health risks, sharing public transit with individuals who might have contagious illnesses, affecting his well-being and potentially leading to additional medical costs.